Applied Digital stock has been a clear example of how violently the market can swing when fear takes over. Since October, APLD was cut nearly in half, wiping out months of gains and shaking out impatient investors. Then, almost as quickly, the stock snapped back with a surge of more than 30% in just 2 days. That kind of movement rarely reflects a business changing overnight. It reflects emotion, positioning, and short-term narratives colliding on Wall Street. While the chart looked chaotic, the underlying story barely slowed down. Applied Digital kept building, financing, negotiating, and expanding capacity during the sell. Data centers were still being poured, power infrastructure was still being installed, and long-term leases were still moving forward. This disconnect often appears early in massive infrastructure cycles. When capital intensity scares investors before revenue visibility fully shows up, the AI boom is not just software models and headlines. It is concrete steel, power, and cooling, and those assets take time to come online. Markets, however, price fear instantly. The question investors need to ask is simple. Is the market reacting to short-term volatility or failing to value the early innings of an AI data center build-out? That tension between panic and progress is exactly where Applied Digital sits today, setting the stage for what comes next for investors. To understand Applied Digital, you have to strip away the stock chart and focus on what the company actually builds. APLD is not selling AI software or chasing consumer trends. Its core business is designing, constructing, and operating large-scale data centers purpose-built for artificial intelligence workloads. These facilities are engineered to deliver massive power density, advanced cooling, and reliability that hyperscale customers require to run modern AI models. Applied Digital also offers turnkey cloud computing solutions, meaning customers can deploy AI workloads without worrying about the physical infrastructure underneath. This positions the company as an owner and operator of critical digital real estate rather than a speculative technology play. The heart of this strategy sits in North Dakota at 2 major projects, Polaris Forge 1 and Polaris Forge 2. At Polaris Forge 1, Applied Digital has already deployed 100 megawatts of capacity for CoreWeave and plans to bring an additional 150 megawatts online. Polaris Forge 2 is designed to add another 150 megawatts, dramatically expanding total capacity. Megawatts matter more than marketing here. In the AI economy, power availability is the bottleneck, and Applied Digital is focused on supplying it at scale, quietly positioning itself as a true picks and shovels provider. What separates ambition from results in the data center world is execution. And this is where Applied Digital's Polaris Forge projects become critical to the story. At Polaris Forge 1, the company has already delivered 100 megawatts of live capacity for CoreWeave, proving that these facilities are not theoretical plans but operational assets. Even more important, Applied Digital intends to bring an additional 150 megawatts online, expanding the site into a much larger revenue-producing engine. Polaris Forge 2 shows just how fast the company is moving. Only months ago, the site was farmland. Within weeks, major groundwork, infrastructure, preparation, and visible construction progress were already underway. That kind of speed matters because AI infrastructure is one of the most competitive build-outs happening today. Hyperscalers and AI platforms are racing to secure power and space before supply tightens further. In this environment, delays can cost billions in future contracts. Data centers are not built overnight, and in the United States, projects can take years from permitting to full operation. Applied Digital's ability to move from greenfield land to active construction quickly gives it an edge when customers are deciding where to place long-term workloads. This momentum sets the foundation for the next question investors must ask. How is Applied Digital funding this aggressive expansion, and what does that capital structure really mean going forward? Rapid expansion on this scale is impossible without capital, and Applied Digital has been very deliberate about how it funds its growth. In mid-November, the company announced a $2.35 billion offering of senior secured notes carrying a 9.25% interest rate and maturing in 2030. These notes were placed in a private offering with institutional buyers, signaling that large capital providers were willing to underwrite Applied Digital's long-term infrastructure strategy. Around the same time, the company also filed an S-3 and announced an offering of approximately $2.44 million shares. At first glance, any share issuance raises concerns about dilution. But in context, this represented only about 0.9% of total shares outstanding, based on a share count of roughly 255.9 million. In other words, the dilution was minimal, especially compared to the scale of capital being raised through debt What matters more than the mechanics is where this money is going. Applied Digital is not raising capital to plug holes in a failing business. It is raising funds to accelerate construction, secure sites, and bring megawatts online faster. In capital-intensive infrastructure businesses, early dilution and leverage are often the price paid to unlock much larger revenue streams later. This funding gives Applied Digital flexibility at a critical moment, allowing it to move quickly while demand for AI-optimized data centers continues to surge. That naturally leads to the next question. What new opportunities is this capital positioning the company to capture right now? One of the most strategically important developments for Applied Digital is the newly completed development loan facility with the Maguire Group. This facility is designed to provide pre-lease development capital, allowing the company to fund early-stage site sourcing, planning, and construction before final customer agreements are signed. The initial draw of up to $100 million is specifically intended to support these early development activities across multiple potential campuses. This type of financing matters because it removes friction at the most sensitive phase of data center development. Pre-lease work is where timelines are won or lost, and having capital ready allows Applied Digital to advance projects without waiting on final lease signatures. That speed is a competitive advantage in a market where hyperscalers are racing to secure future capacity. What really stands out is management's disclosure that Applied Digital is in advanced stage negotiations with another investment-grade hyperscaler for multiple campuses. That phrasing is deliberate. Companies do not typically reach this stage without serious intent, and they rarely announce it without confidence that funding and site readiness are already in place. The Maguire facility appears to be the missing puzzle piece that enables these negotiations to convert into formal deals. It suggests that Applied Digital is positioning itself not just for one customer, but for a pipeline of long-term hyperscale partnerships. With development capital secured, the next catalyst likely shifts from speculation to official announcements, bringing us directly to the revenue impact that could follow. All of this construction, financing, and negotiation only truly matters when it begins to flow through the income statement. And this is where Applied Digital's story starts to change shape. The foundation is the massive $11 billion contract with CoreWeave tied to Polaris Forge 1, a long-duration agreement that locks in predictable revenue over many years. On top of AV, that Applied Digital has announced a separate 15-year lease valued at roughly $5 billion for 200 megawatts of capacity at Polaris Forge 2, further extending visibility well into the next decade. The key shift ahead is lease revenue recognition. Until data centers are operational, cash burn dominates the narrative. Once megawatts go live, that narrative flips. Lease payments begin, margins improve, and the business starts to resemble a long-term infrastructure operator rather than a development stage builder. This inflection is expected to begin next year and ramp meaningfully as additional capacity comes online. Wall Street analysts are already modeling that transition. Applied Digital reported $64 million in revenue in the most recent quarter, representing an 84% year-over-year increase. For the full year, analysts expect revenue to reach approximately $297 million. That figure is projected to climb to around $553 million in fiscal 2027, followed by a move toward nearly $1 billion within the following 2 years. Those growth expectations help explain why the consensus price target for APLD sits above $42 per share, with all 10 covering analysts rating the stock a buy. The market, however, still appears divided, which brings us to an important voice in this debate. The company's own CEO and how he views valuation versus future cash flow. When a company is still burning cash and building at scale, skepticism is inevitable, and Applied Digital is no exception. That tension was addressed directly by CEO Wes Cummins, who has been clear about how he views the company's current valuation versus its future earning power. His argument starts with context. Applied Digital is not losing money because demand is weak. It is spending aggressively because its largest projects are still under construction and not yet generating revenue. Cummins has pointed to the $11 billion in contracted revenue already signed, noting that this single contract alone is expected to generate roughly $500 million in annual net operating income once fully ramped. Importantly, those cash flows are locked in through long-term agreements lasting 15 years, with extension options that push visibility even further into the future. When viewed through that lens, today's cash burn becomes a temporary phase rather than a structural problem. Looking ahead, management has stated there is a clear line of sight toward $1 billion in net operating income as additional campuses come online and new contracts are added. against the market capitalization in the mid-single-digit billions. Cummins argues the business is not wildly overvalued and may, in fact, still be underappreciated by the market. This perspective highlights the core disconnect. Markets often fixate on current profitability, while infrastructure businesses are valued on durable, long-duration cash flows. Whether investors agree with management's conviction ultimately shapes the final decision. And that brings us to the most important question of all. Who should actually consider owning this stock? Applied Digital is not a stock for investors looking for quick wins or smooth price action. This is an early-stage AI infrastructure compounder operating in a capital-intensive, highly competitive arena where volatility is part of the journey. The company is still in the heavy build phase, meaning execution risk, funding needs, and market sentiment will continue to drive sharp moves in both directions. For patient investors, however, APLD offers exposure to the physical backbone of the AI economy. Long-term leases, multi-year contracts, and megawatt-based revenue create the potential for durable cash flows once projects fully come online. Key catalysts ahead include the upcoming earnings call on January 7th, progress updates at Polaris Forge 2, and any confirmation of additional hyperscaler partnerships. That said, competition is fierce. Construction timelines matter, and any delays or cost overruns could change the outlook quickly. This is a stock that rewards investors who understand infrastructure cycles and can tolerate uncertainty while waiting for revenue inflection. Ultimately, Applied Digital represents a bet on execution and scale rather than hype. The information is on the table. The risk is real. The opportunity may be substantial. From here, the decision belongs entirely to you.